You know what keeps coming up a lot that I've been hearing? The term forced selling. You know what forced selling means? It means stock market and bond market collapse. I was there in 1987 on Black Monday. I know what that looks like, smells like, tastes like, everything. And let me tell you something else. When there is forced selling, everything gets sold with it, except for physical gold and physical silver. There is a higher share of distressed junk debt foretells defaults. So this is in our very near future. The distress ratio leaps to 7.6%, surpassing the 5-year average. That's like danger, danger, danger. So the warning signs are out there. And an uptick in corporate defaults is coming, and probably not that far down the road. And it's not just here in the US, because we're all incestuously interconnected, but now Europe's safest firms of record record biggest jump in bond coupons in decades. That means interest rates going up, bond coupons. Rising costs are headwinds for, I'm going back here for a second. I don't want that yet. Rising costs are a headwind to profitability. You think? I mean, we've seen so many times how these corporate profits just went straight up through COVID-19 and the whole pandemic, etc. Well, now guess what? With the interest rates going up, the opposite is happening. And they've got rising costs on this mountain of debt, as well as the inflation for whatever they're inputting. Blue chip European companies saw the biggest weekly rise in the interest rates they pay on their bonds in a decade, a sign of the increased pressure on corporate balance sheets. And this is what that looks like. Average coupons in high-grade bonds surged the most since 2012. What was going on in Europe back then? The sovereign debt crisis. So are we in a debt crisis right now? Yeah. The debt markets are falling apart. Let's make no mistake about that, because I think what we're really watching is the fiat financial system bubble popping. So that means bonds plus stocks plus everything. The treasury bond is the biggest thing, because how are they going to bail that out? So the treasury is going to buy back treasuries? I mean, this is not going to work. This should tell you how close we are to the end. So we've looked at the government, treasury bonds, and we've looked at the corporations. What about the individuals? Fed's latest rate hike cost credit card holders $5.1 billion. Yeah, that's per 75 basis point hike. They're going to do a 75 basis point hike again? They might do 50. It doesn't matter. I'm going to show you in a second. But these are credit cards on revolving credit. And you can see that they far surpass where we were in 2020. And you can see also from, forever, that the credit card balances just keep going up. But now more people are using them just to buy food and gas and energy and the things that they need. So that's happening while at the same time interest rates are going up. This is a huge problem, and I hope you can see that. Aggressive central bank tightening has piled on billions in additional interest costs. So if the individual could not afford the food at the grocery store and they put it on a credit card and they're not paying that credit card off every month, now they're tacking on all of that interest. And before you know it, some people may be already compounding that interest. You ever getting out of debt when you do that? Nope, not at all. This is what that looks like. All right, here you go. 75 basis points, $5.14 billion in additional interest costs. But Let's say the next one is 50 basis points. That's still $3.42 billion in additional interest costs on these credit cards. And even if they do a 25 basis point move, that's still $1.62 billion. Do you see the problem? And these credit cards are compounding that problem on top of the inflation and the prices that everybody's having to pay for things. So what do you think? You think we might have a distressed consumer as well? So we've looked at a distressed treasury market where the treasury may step in to buy the treasury bonds back. You see the stressed or distressed corporations with higher interest rates and higher costs, and the distressed consumers. I'm thinking we got a real problem on our hands here. If you like this clip and you want to watch the full video, just click right here. And to subscribe, click right here.